Hi, very good afternoon to all of you. If you look at global economy, thanks to China, commodity prices have started correcting. And despite geopolitical risk in Middle East and Eastern Europe, commodity prices have remained on the softer side. This has resulted into inflation coming down across the world. This is allowing central banks to cut rates. And now market is expecting Fed to cut rate in this calendar year. As liquidity conditions improve, interest rates came down. IMF is expecting global growth to remain stable in this calendar year. US will still be growing at about 3.2%. And emerging market, including Asia, will be growing at about 5.4%. Obviously, there is a risk of in the market today. While IMF believes US economy will have positive growth of 3% plus this year, there are fears for next year, recession or soft landing. Israel-Iran conflict also creates doubt on the geopolitical side. Unwinding of yen carry trade is something which we had not heard about 10 days back, but now everyone is talking about. China's slowdown is also a worry. And in our neighborhood, Bangladesh crisis also creates its own sets of trouble. If we look at US per se, the unemployment rate slowly and steadily has started inching up. In US, the denominator of unemployment is essentially people who are willing to work and are unemployed. A large part of unemployed people are taken out of denominator, saying that they are not willing to work. So all the poor people, homeless people are not considered part of unemployed, saying that they are not willing to work. But even with that gimmicky, unemployment numbers have started inching up. And for the first time, the manufacturing PMI is going below expansionary zone, which means US is entering into some sort of recession. The geopolitical risks, thanks to Middle Eastern crisis, remains on the boil. There are rumors of Iraq not permitting flights to fly over Iran air zone. So there is some sort of thing likely to happen in Middle East which will keep these tensions on boil. Yen carry trade, when yen was moving from $80 to $110 and $110 to $160, everyone was enjoying party because interest rates were near zero. In one fine sweep, yen moved from 160 to 142 as Bank of Japan increased interest rates, and every Tom, Dick and Harry who had borrowed money in Japan and kept currency unhedged had to unwind. Global market witnessed sharp correction across various asset classes thanks to appreciation of yen. China continues to remain conundrum. Their non-performing loans are slowly and steadily rising because of real estate, and residential prices continue to remain suppressed because of excess supply. So overall, global economy looks on a shaky ground. If we come to US, Fed raised interest rates at the sharpest possible manner and has been very, very constrained in taking out liquidity. US national debt is like Star Trek, going where no man has gone before. It's now $35 trillion. Per taxpayer, that's burden of $268,000. Thanks to that huge amount of debt, US economy is still posting positive growth. Fed, obviously, thanks to COVID, has gone up on debt to GDP ratio at about 125%. Households and corporates are more or less stagnating at around 75%. US interest payment is now at all-time high level in their history at about 4.1% of GDP. More importantly, law of marginal diminishing utility is applying to US. For every dollar of debt that they create, the incremental GDP is just about 58 cents. The manufacturing PMI, as mentioned before, has moved into recessionary territory or non-expansionary territory, going below 50. Labor market slowly and steadily is showing signs of weakness with people applying for multiple jobs. And as I mentioned before, the denominator of labor unemployment is suspect, as it only includes people who are willing to work and who are unemployed. One big driver for US economy was the real estate and housing market that continues to remain unaffordable as house prices have gone up significantly and new supply is not emerging because people have locked into fixed rate mortgages on their houses. 80% of US mortgages will be around 3.5% fixed rate. The new mortgages will be probably at 7%. So people are not changing their house. That supply is less, and hence house prices have remained on the higher side. S&P 500 looks expensive versus historical levels. And someone like Berkshire Hathaway is selling US equity on an aggressive basis. Now, Berkshire Hathaway owns more US Treasury bill than the mighty Fed itself. And Berkshire Hathaway is sitting on about $227 billion of liquidity. Undoubtedly, Fed is keeping everyone guessing. And in all the conference calls, analyst call, Fed name is taken as if it's a god. In the Indian economy, our story continues to remain good with reasonably solid headlines. The budget pursued the path of fiscal prudence despite coalition government. The thrust on capex remained at 11.1 lakh crore or about 3.6% of GDP. The primary deficit came under control at 1.5% of GDP, and growth numbers looks reasonable at 10.5% nominal. RBI is expecting 7.2% real GDP growth in today's credit policy. Overall, India remains in a reasonably good shape. If we look at high frequency data indicators like railway freight, port volume, petrol diesel demand, bitumen demand, coal production, numbers are looking quite reasonable for our economy despite election and despite heat wave in this summer. Economic activity are at all-time high, and overall expansionary mode is likely to continue. GST collection 1,60,000 crore is becoming normal. PMI consistently remains above 50 in expansionary zone. Infrastructure built over last 10 years, which almost doubled our infrastructure from 2014 base, is now aiding productivity and efficiency. We believe this trend of investing for future by government is likely to continue to move up. Infrastructure investment should move from roughly about 5.5% of GDP to 6.5% over next couple of years. And total investment as a percentage of GDP after declining should start inching up all the way in the coming years. Undoubtedly, there was a slowdown in investments due to election and summer heat. The transitory government was not awarding contracts, but now with 11,000 crore rupee to be spent on infrastructure investment, we believe investment ordering should take off. Our share in manufacturing, exports and services is on the up move. Obviously, we have major commanding share in services at 4.9% versus goods exports at 1.8%. As per RBI claims data, in last year, 4.7 crore jobs were created. These are more likely to be casual jobs rather than well-paying jobs. But limited point over here is that there is enough jobs available at the lower level, albeit our problem is how to make them well-paying. Despite Middle Eastern crisis, oil has remained well-behaved. It's now down to about $76, favoring India's external account. Monsoon has been fantastic. There is reasonable distribution as well. Reservoir levels are almost exceeding 10-year average, except in north. But north is river fed. Overall, this monsoon should aid rural economy and agriculture. Put all these things together, India remains at the top of emerging market peer group with composite index score, which is well ahead of its peers like China and other countries. Converting that solid economy into equity markets, well, as our economy has moved ahead, our contribution to global market cap has also reached all-time high level. Our market share in global GDP is about 3.6%. Our share in global market cap is about 4.4%. Market cap to GDP ratio remains at all-time high of 142% against historical average of 85%. Undoubtedly, people are legitimate in saying, isn't market expensive at this high market cap to GDP ratio? Well, the answer is that as market cap has gone up, so has the profitability. India is also sitting on all-time high profitability this year, and hence market cap is at all-time high level. Corporate India should deliver profit of about 15 to 16 lakh crore this year. The good news is factored into the prices. Nifty trades at about 14% premium to long-term average. Small and mid-cap are at about 40 to 50% premium to long-term average. To some extent, we need to make adjustment in this long-term averages, as in indices, more private companies have come in and government companies have moved out. More domestic companies have come in and global companies have moved out. More B2C companies like Trent and Titan have come in, and B2B companies have moved out. All this has resulted into valuations going up. Today, both Titan and Trent will trade at above 100 P, pulling Nifty's P ratio on the higher side. And that adjustments we'll have to make in this premium calculations. With those adjustments, we still believe large cap is reasonably priced. Small and mid caps are at some premium to their historical averages. One reason why domestic markets are supported is because of the domestic investors' participation. Between mutual funds, insurance, and retail, domestic ownership of equity is almost touching 26%. whereas FPI ownership is now at about 17%. Keeping in mind long-term growth story of India, FPIs have turned buyers in India in the month of July. In August, they have become seller. FPIs are like drunken master, difficult to figure out what they are up to. In this year, January they sold, Feb, March they brought, April, May sold, June, July they bought, August they are selling. आ रहे हैं या जा रहे हैं कहना मुश्किल है. One of the reasons why FPIs will be buyer on a longer term basis is this chart. You could clearly see how MSCI China index is stagnating versus MSCI India. There's a divergence coming post-COVID, and this is primarily driven by the earning per share of India versus China. China companies' profitability is stagnating, whereas Indian companies' profitability is constantly on the up move. At the same time, we need to be cognizant that a lot of the stock market return has come on PE expansion or valuation growth. For example, the PSU stocks which have delivered fantastic return over last 2 years, 72% return is because of the PE expansion and 17% return is because of the earnings expansion. Companies where floating stock is limited up to 20%, a lot of their valuation expansion is resulting into earnings performance. With this kind of valuation, it looks like that now earnings have to move to deliver return. The first quarter FY25 quarterly numbers were not as encouraging. The total profit growth was about -1% year on year, ex financials, and 5% including financials in Nifty. The small cap delivered about 9% growth, but mid cap had flat earnings. Profit growth last quarter has been impacted because of summer hit and election. But overall, in next 9 months, that is July to March 25, profit growth has to pick up. This quarter's numbers are either in line with expectation or little below expectations compared to street. Notwithstanding that, market still believes for this year Nifty 50 earnings will be 1120 rupees, and next year it could be about 1320 with 14.5% growth. When we begin the year, this number was hovering at about 1130. Now it is down to about 1120. Keeping all things in mind, we believe this is time to be overweight large cap, marginal underweight small and mid cap. One interesting analysis: in NSE 100, 88 stocks have delivered more than 100% return from COVID lows in last about 4 years. In BSE 500, 359 stocks have delivered more than 100% return since COVID time. 43 stocks have delivered 10x return in BSE 500, and 3 stocks have delivered 10x return in NSE 100. Courtesy that great performance from 93 stocks trading above 50 PE on Jan 20. Now there are 228 stocks, almost half of index, which is trading above 50 PE. Market is discounting for 228 companies up to 2074. If you look at the return profile between December 05 to Jan 20 for 15 years, broad market delivered about 10.9% return. Post-COVID, that went up to 21.03%. And if we combine both this return, that's about 13%. So 05 to 20 returns were moderate at about 11%. Then there was acceleration post-COVID at 21%. And that's why combined average is about 13%. This number doesn't look high. This number looks high. Now, Poonam ke baad Amas aati hai. So you can very well expect what will be the return going forward in next 5 to 10 years. So the way to interpret this data is that in last 5 years, between Jan 20 to July 24, we have seen exceptionally good period. Ab betting pitch over ho rahi hai and bowling pitch pe jaकर run banane hain. The other way to look at this is percentage small and mid cap ownership as a percentage of total market cap. About 63% of market cap is large cap and 37% is small and mid cap. Normally at this level, large cap starts outperforming or return starts moderating. Across our asset allocation fund, we are right in the middle. Balance Advantage fund at 55% equity allocation and multi-asset allocation fund at about 57%. Going forward, 3 sectors continue to look reasonably priced. One, private bank. This is one of the rare periods where on a 3-year, 5-year basis, private bank has delivered lower return than their fixed deposits. Is this time to buy private bank? If you remember our last call, we had said yes. Now we are saying please wait. What happened? Well, there is a liquidity coverage guideline which was released last month, and that can impact banks' profitability by 10 to 15 basis points. Today it is consultation paper. If it gets converted into guideline, we expect private banks to go down another 5 to 10%. If it doesn't happen, then there will be bounce back. So private bank, last time we had mentioned you should be looking to invest. Now we are saying please wait. FMCG has already run up a little, but we still think there is opportunity in consumption space as election, monsoon and budget will put money in the pockets of consumers. IT has started moving up, but we still think there is valuation catch up and there is better earnings prospect, especially in mid-cap IT companies. So at this point of time, we believe IT should do well. One can invest over there. FMCG, despite run-up, one can look to invest. And in private bank or PSU bank, it's time to wait and watch for liquidity coverage guidelines. Our fund, Kotak Consumption Fund, covers the theme of consumption, and Tech Fund covers the theme of IT. Overall, we believe there will be events like US Fed pivot, cutting interest rates in the month of September, energy prices remaining around $80, consumption recovery showing continuous improvement in rural India, and geopolitical risk. Those are the things which is likely to impact our market. Yen carry trade reversal is something which got added this month. But overall, we are in a reasonably good shape. Time to choose quality over momentum, high floating stock counters over low floating stock counters, and reasonably valued sectors like IT, pharma, FMCG, private banks over expensive sectors. On investment side, SIPs continue to deliver. Our funds continue to deliver value add on a rolling return average across both hybrid and pure equity. On a point-to-point basis, mid-cap is one fund where we are underperforming benchmark index on a 3-year basis. But this has come down from about 9% to minus 3%. And we hope that we should be able to catch up. Across most of our equity funds on a point-to-point basis now, we are generating outperformance over benchmark indices. And if you look at SIP returns, Again, pairing small cap and mid cap across most of the funds, we are able to deliver better return than benchmark indices. Kotak Equity Opportunities, which is blend of large and mid cap. Kotak Contra Fund, which is taking contrary bets on the market. And Kotak Multi-Cap Fund, which is divided across large, mid, and small. These are some of the product appropriate at this point of time. Do also look at our performance in Quant Fund. We had launched this just about 10 months ago, and so far it has delivered fantastic outperformance with about 22% alpha over benchmark indices in last 10 months or so. Coming to fixed income, US inflation is easing off as mentioned earlier. Now people are expecting 3 rate cuts between September 24 to Jan 25. The 2-year and 10-year spread in US has compressed. Global bond rally is gaining momentum as bearing country like Japan, everywhere interest rates are being cut. The RBI is managing liquidity quite nicely. The budget has maintained path of fiscal prudence, so net borrowing program is lower than last year, one of the rare situation in market. And overall, there is likely to be shortage of government securities. Demand is likely to exceed supply in FY 2025. Our inflation remains reasonably under control on a core basis. But again, today in credit policy, RBI governor reiterated that even food inflation, if not checked, could spiral into other inflation. So we'll have to focus on headline inflation, which is behaving well, but is still above RBI's mid-target range of 4%. And core inflation, which is well below 4%, probably is not going to get as much attention. I talked about in equity risk of liquidity coverage guideline. If that guideline comes as per the consultation paper, there will be additional demand of 2 to 5 lakh crore of government securities from banking system. If that happens, then we are looking at 10-year yield going below 6% compared to current 7%. This is time to go and buy longest possible maturity. I have told my fund managers, buy on the longest possible duration. If I can have all their portfolio in 50-year government securities, I'll be very happy to do it. On the fixed income side, apart from duration, there are hybrid funds available, balance advantage fund, equity saving fund, debt hybrid scheme. All of them are reasonably attractive at this point of time, thanks to duration play. Unfortunately, in the budget, grandfathering of debt funds have been taken away, and their taxation liability from now onwards will be at 12.5% as and when they redeem. My recommendation will be let them continue investment in debt funds. The duration should play out and they should get good return staying invested in debt at this point of time. Gold, we have been bullish gold, but also cautioning on import duty cut. This budget import duty was reduced from about 15% to 6%. And we believe now, hopefully, there will be no more reduction in import duty. And hence it is time to accumulate gold. We are bullish gold because of central bank demand. 3rd year in a row, they are likely to buy more than 1,000 tons of gold. This is creating short squeeze. Supply is not emerging and demand for gold continues to remain strong. Despite 3,000 tons of gold buying in last 3 years, gold as a percentage of global FX reserves continue to remain on a lower side.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.